Hey folks, welcome to our MOU webinar, Canadian Climate Institute. We'll just give folks another minute. We have about 70 people on the line, and we'll get going in a minute or so. All right, we're up to 90. All right, welcome to the Canadian Climate Institute webinar on the MOU. It's been a fun few weeks, fun few months around climate policy in the country and energy policy in the country. Today, we're going to walk you through some of our analytics. We'll have a short little presentation. We'll hold a Q&A, and then we'll try and answer some questions, and we'll go from there. My name is Dave Sawyer. I'm the principal economist at the Canadian Climate Institute. I'm also head of 440 megatons. I'm coming to you from the unceded and traditional lands of the Anishinaabe, Algonquin, just south of the city, adjacent to the Rideau River in Kars, Ontario, Kars, and a lovely spot in the world. Yeah, I'm ready to get going. Bit of housekeeping. I'm going to introduce Ross here. Ross can introduce himself, and after you, sir.
Perfect. Thanks, Dave. Hi, everyone. I'm a research lead at the 440 Megatons project, like Dave, located on the traditional unceded territories of the Algonquin Anishinaabe. Just a couple of housekeeping notes. There's going to be a Q&A afterwards, and please feel free to ask questions in the question and answer box function during the presentation. We'll come to those at the end. Pour les francophones qui sont ici, nous avons activé le sous-titrage. Vous pouvez y accéder en bas de votre écran de Zoom. Et si vous souhaitez poser des questions en français, je peux y répondre en français plus tard. And one final note that if we don't get a chance to get to your question today, we'll try to respond by email. So please feel free to follow up by email after the webinar. Thanks, Dave.
Thanks, Ross. I want to start with some acknowledgments with the Institute. We have a big team and we have a big communications team that really helps research take our wonky writing and turn it into something that's a little more digestible. Although in the latest insight that we just put up that I wrote, it's a little more wonky than communications likes. And so there's always this tension, and they always make our work better. I mean, plain and simple. So I want to recognize them. We've got a great engagement team who set this webinar up, and yeah, the Institute is a really well-oiled team. Works well together. We have a lot of fun, and we also work hard on a really interesting, on a range of interesting topics, thematic topics in climate change. So for those who don't know the Institute, we have the 440 indicators group tracking progress. We have a big Indigenous group that just launched a report on Indigenous housing. We've got an adaptation group working on damages and adaptation policy, clean growth group, and a mitigation group, and then a large communications team to support all of us. And so, yeah, we're really fortunate to be sitting in the organization we are. The other acknowledgement I want to make is to Navius Research. Navius Research has been a really solid partner of ours since the inception of the Institute, just over 5 years now. And so they work really hard, and we have a good partnership with them, basically trying to tumble the numbers. And then the other piece to recognize, some of the analytics we've done here is, we've done internally at the Institute. So it's a bit of a blend of Navius, and then some of the market insights we generate ourselves, and we can get into that in more detail. So with that, I will share my screen, which is always fun in these differing, share my screen. Why do I not see share my screen? There it is. I'm always a little blind. All right, you can see my screen, okay? Nod, Ross?
Looks good to me.
Looks good, okay. So the title, I mean, this is a title that I like. This is why comms doesn't allow me to pick the titles all the time. But I mean, for me, what this boils down is much MOU about nothing, much ado about nothing. It's not nothing in the end, but considering the smoke and fire that was surrounding the MOU and the MOU process going back a number of months, we ended up in a place, certainly on the emissions side, that is not fundamentally different than the current trajectory we're on with the policy that existed in 2025. Certainly on the energy side, the pipeline is a material change, right? Could be a material change in production, in GDP, in economic benefit. And then the question is, okay, well, what are the implications across all the elements of the MOU? Because it's not just carbon pricing, although we focused on that, and I'll explain why. Um, but there's two objectives here clearly with both governments, and one was economic development, and one is to control emissions. So we, being the climate folks, we said, okay, what's the net effect of emissions? And our big takeaway, you might have seen in the insight, is it leaves emissions largely unchanged from the current trajectory, and I'll come back to that as we go along. So major policy redesign, limited emissions impact. It really is a large policy package, right? So you've got the methane. Now, the methane regulations we're tracking anyway this way, but certainly they were catalyzed to get a federal regulation that came out and a companion, I'll call it a companion Alberta regulation that came out. The final equivalency agreement on methane under the Canadian Environmental Protection Act will be rolled out eventually. But it's a big chunk of national emissions. Methane is really important, fairly inexpensive reductions there. So the general thrust of the movement towards a 75% reduction, delayed in time under the MOU, compared to what we were looking at earlier, is a good thing. So that's just one element of the package. We have the the clean electricity regulations that are an important piece of regulation. Some challenges with them around cost and stranding assets, especially in Alberta, which explains the contention coming out of the Alberta government around basically chopping off the profitability of new coal to gas plants and combined cycle plants, and basically limiting the profitable life on those units. And the concern there was would lead to significant price increases in the pool price, right? Gas sits on the margin. You add a carbon adder on it. You add a CER constraint. You get scarcity pricing really quick because the CER is basically squeezing down the hours a lot of these peakers could run, but also chopping off the end of life of some existing facilities and forcing them to go to CCUS. So you had sort of carnage. You could have carnage in the market under the old CER, and this agreement basically looks at that, says, okay, we're going to change that. We're also going to add in a bunch of renewables and hopefully unstick renewables that have been more or less shut down in Alberta. So some really interesting stuff out of there. Of course, that rolls out nationally to the rest of the country. The clean electricity regulations and the methane regulations then have implications for everybody else. And then finally, the large emitter trading program. So the headline price under the GEPA, the Federal Greenhouse Gas Pollution Pricing Act. And so the new headline price has implications there. So when you pull it all together, it's probably 40 to 50% of our national emissions were just impacted by this thing. And then you have to counter, of course, 20 megatons or so of emissions from 1.4 million barrels of new production a day, assuming the pipeline goes ahead. You model in a bunch of pathways that is a little uncertain, but even if you're a little generous, we basically end up at the last point here on the slide, which is relative to the current trajectory of emissions, we're up or down 10 megatons or 7 to 10 megatons on an annual basis. So that changes in time. I'll show you a chart. But if you look at the 2030 to 2050 period, it looks to be about 7 or 10 megaton average difference between a couple scenarios that basically boil down to whether or not the carbon pricing intentions in the MOU can be implemented as hoped. So yeah, that's the sort of high level context. So what changed really I talked a bunch there, but what changed in pricing, right? So we got a new national headline price The next morning, Environment and Climate Change Canada put up a new minimum national carbon price, national standard, basically a lower price trajectory. The benchmark tightening rates that were listed in the implementation agreement are at least half or more for the oil sands facilities against what was basically in effect in 2025, although they were slowed down with the order in council. There was some uncertainty put out in late December of 2025 about what those benchmark rates, tightening rates would look like. But yeah, more than half demand in the system, and we'll talk a bit about that. New administered price floor. So a new price floor comes in, and ideally a price floor is there to act as insurance when prices collapse, to set a minimum price and add investment certainty into the system. And the question is, and our question is that administered price floor really going to work as hoped and as intended? And then the price floor also has some exemptions and there's a line in the sand about vintaging on the year of issuance of credits, when they can be used and when they can't be used. And I'll talk a bit about that. And that has all kinds of implications for the size of the bank. It has implications for compliance behavior. And then it ultimately has implications for stringency and time. And so I'll talk a bit about that. And then the investment credits were enabled at a lower rate, but they're still enabled. So they're in there. And that has an impact on the market. We saw prices drop in August of last year down to $17 when that was originally down from like high 30s, mid 30s, down to $17 when the government of Alberta announced that particular change. CCFDs are brought into the system. Some question about whether or not it's a full liability or a capped liability. So that yet to be determined. And then I talked about the production capacity and the various regulations and methane changes that occurred. So that's what changed. So quite a lot has changed, right? And there's still a lot to do, and there's still a lot to emerge. The implementation agreement doesn't lay out very much. So stay tuned, but we can have a sort of preliminary view of what we see here. So this is the chart in the insight. The black line is basically, it is emissions that we project using the Navius modeling based on the conditions that existed, the policy conditions that existed in 2025. And then we do two scenarios from there, and I'll explain what's in each of these. And then we do two scenarios. We assume that the green scenario, that the price floor works as intended, because we know policy doesn't always work as intended. So we also modeled, okay, what happens if the price floor doesn't work? And that also gives us an equilibrium price in the market, which is important because the tightening rates, in an already fairly loose system that was tightening fairly well under the old system, prices were rising under the old tier program. The relaxing of tightening rates takes a lot of compliance pressure off, and so that has an impact on demand and on the price floor, and I'll get into more detail there in a second. So that's as in 2025 is the black line, and then red is no floor, green is floor, and this is all in national emissions. And basically, we have all the policies in here. So what do we do? So in the benchmark scenario, the reference case scenario in 2025, in there we have tier at $95 and its current and its old tightening rate. So oil sands at 4%. That had an average tightening rate of just over 3%, about 3.5–4% if you looked across all the compliance obligations, because oil sands is such a big chunk of that market. So tightening at a fairly fast rate, actually. And so that's in there. Zero price in Saskatchewan. The current prices we see, the old headline prices in all the other jurisdictions, their benchmarks are untouched in carbon pricing. We have CER, which is fairly in the old CER, more stringent CER is under the old draft regs. We're in the model. Methane standard of 75%, hitting just in basically 2030, 2035, and that sort of time frame. And then we have all the other policies that we typically model at the Institute under our assessment of the emission reduction plan of the federal government. So we have EV policy in here aligned with the current strategy. We have subsidy programs in here. We have biofuel standards, clean fuel regulations, provincial subsidy programs, Quebec's cap and trade, So we have a fairly detailed representation of current policy, which we leave alone. We don't touch, and we just turn the knobs and dials on the MOU policies, including more oil production. And then we have the two price floors, and then we have in there we have basically some assumptions. That the big difference in these scenarios, it really boils down to whether or not the price floor works. And we assume the same tightening rate that was announced in the implementation agreement, and the same headline price and the same floor when it binds. And so both these scenarios have the same headline price. And then we basically spin the model out and see what happens. And this is what we get. And this leads us to our conclusion to say, well, a lot going on there. And basically, the 20 megatons or so of emissions from a new pipeline is mostly somewhat offset, not entirely offset. And you've got puts and pulls in emissions. So you got more emissions coming from oil sands expansion. You've got less coming from methane and oil and gas. You've got basically Saskatchewan going from zero to something. So we actually get a bunch of emission reductions outside of Alberta, because Saskatchewan goes from zero to something. But then we have an offsetting reduction in the other provinces. British Columbia, Ontario drop down to a lower headline price with the same stringency rates. So there's a bit of a net effect there. So anyway, we spin it all together, and this is where you end up. So last couple slides. So for us, this is a little, it comes down to the price floor. So when we look at the market fundamentals, this is really the big finding, right? So in our market model that is, has tier compliance in it, it has offsets, it has the existing bank, it has a good representation of the current stringency rates by sector, and it has the tightening rates, offsets, compliance channels, ceiling price, the whole, it represents the market fairly well. The market settles well below the price floor. And so the direct investment credits factor in there. They're putting more supply into the system. And basically, what that means is that the floor, which because it sits above the market fundamentals, basically becomes a load-bearing feature in the system, and that the compliance with the floor basically is offside with the fundamentals. And so that places a lot of pressure on the floor, and the floor then becomes a de facto ceiling price. You still have a share of compliance at the ceiling price, but you don't see basically the market trading, so trading modules and offset compliance demand, basically pushing prices up as scarcity emerges in the market. Tightening rates simply aren't there. So you have all these transactions happening at the floor price, and because you got a lot of units in the system, you basically are stranding a bunch of units that are falling in value in time, because the way, and this gets a little not technical, but it's a bit of a mind bender. You basically, unit 1 year doesn't, if you're holding it, it doesn't rise with the market price or expectations or the floor. It's stuck at that price forever. And so it's losing value in time. And so and then there's not a lot of demand in the system. So this basically does, basically sets up these two sets of units, compliance units and a bunch of units that you can't really use. The other thing the floor does is by putting a sort of a grandfathering, a line in the sand that says pre-2027 units. Depends where it lands, but pre-2027 units are exempt from the floor. Well, they have a vintage life on them of 5 years plus 6 years. So in the first couple of years of the floor, you've got a bunch of units that aren't subject to the floor. And so that means the floor is not really binding there. So that takes a little early pressure off of stringency. And then the post credits also, they sort of, the post 2027 credits, they're subject to the floor, so they march along. So you've got this little delay happening in stringency at 2030, 32 as the vintages naturally expire, like they just go away, but they sit there, so that undermines the floor. So what we really see here is that the abatement effect, the price driver, because the fundamentals are below the floor and the floor doesn't bite, we don't have a lot of abatement going on. And then in the future, we basically have paper compliance. So you get some abatement because the headline price acts like an emissions tax. You got to do at least 90% of your compliance there. From pay or abate is basically what the fund credit limit is about. And then you got these other compliance options. And so there is some abatement going on, but generally it turns into a lot of paper abatement, which looks a lot like the system right now. So the system moves from like a market we would hope like to see under WCI that's been strengthened, or the EU ETS that is slowly marching along at our sort of normal rate, to a market that sits at the floor, a lot of units out there, paper compliance. And although we have a floor, and the Institute, we've been pushing hard for a floor. This floor in particular has some design quirks that look a little wonky. And then the market fundamentals, right? A floor should be insurance against a crash. It should not be a ceiling against market fundamentals. So that's basically why, you may say, well, Institute, you've been pushing for a floor. Yeah, we still like a floor. Procurement, this then throws into question procurement, because procurement, I think of it like a bathtub. So the government buying units to pull those units out to put upward pressure on the prices, especially in the short-term period before 2030, clear the bank out. Because there's low stringency in the system now, you're basically filling up the bathtub with renewed credits and offsets, and spending government money or tier revenue from the fund to pull out units, and your level really isn't changing and you're wasting money. So you may have a price that's rising, but you're doing nothing on the compliance side, because you've still got you've got an oversupply problem. And this is one of the challenges with procurement. So some might say, okay, we should jump into procurement. We would say, okay, hang on, let's get your sharp pencils out and take a closer look at that. So that's a long ramble, but for us, the floor really sort of matters on stringency, and it matters for the outcome of the MOU. The pipeline creates a lot of emissions. CCUS can help. Technical challenges there can help. And then it's really the large emitter programs that need to offset that 1.4 million barrels a day of increased upstream production and emissions, and then tighten the system up generally across all the other emitters. And so you could say, hey, well, you guys at the Climate Institute, now your modelings don't care. Like you're looking in the future, you got it wrong. The market has spoken. So I just looked, there's been a couple of things out this week. I just looked at ICE this morning, the ICE exchange. I looked at it on Tuesday this week. It was $40, $32 today. And this mirrors what we're hearing from others in the market. So the market is basically pricing in a loose, lack of scarcity. I mean, this happened as well with the direct investment credits in August of this year, in August of last year, sorry, 2025. I mean, that's 25% as a price crash, right? It's not quite as bad as last time, but that's a price crash. I mean, no matter how you say it, and that is a direct response to stroke of pen risk. So the market participants have, I think they were slow like I was. It's taken me a while, and I've been spinning numbers and models for about a week, 2 weeks on this, plus trying to figure out what's going on. And it takes a little while to really get your head around it, and how the floor is going to protect that weak stringency. And in the end, when you look at it, you have to question whether or not that design can deliver. I hope it can. Can it be reworked? Reworked, yes. But let's just see. And yeah, so so what are the three takeaways? I mean, I'm harping on this issue, right? Major policy redesign, modest emission gains, little missed opportunity, I think. The floor becomes the load-bearing feature given the market fundamentals. I mean, the other thing I didn't mention, so the regulated floor means that, and the MOU is a little inconsistent on this, but let's assume it's at the point of compliance where you submit your compliance credits. You have to verify and submit paper that says you paid the floor price for that unit if it's subject to the floor. Think about the MRV in that. And think about all the issues around transfer pricings, facilities that own offset projects or have multiple facilities. You got transfer pricing going on where you can shuttle stuff around. The MRV on this to make sure the floor works is mind-boggling. And so just sit back and think about, okay, you're the regulator. How are you going to verify that the floor price was paid here? Someone once said to me, and this is in fisheries management, the fisheries regulators, for every 10 people who design the regulation, there's 60,000 fishers trying to work around it. That's how the market works in regulation, right? So the MRV risk here is not simple in this regulated price floor, administered price floor. And then, yeah, so their long-term trajectory remains largely unchanged. So I will stop there and open it up, and I will stop my presentation so I can see, oops, stop sharing. That's bad. I gotta stop sharing. Sorry, folks. Sorry about that. Ross, how are you?
I'm doing well. Thanks, Dave. How are you?
Good.
I will start running through the questions. They are starting to pour in even more quickly as I am speaking. So I'll start with some of the basics because some people were wondering about the assumptions and maybe missed some of the description. So, Dave, could you start by really briefly reiterating some of the core assumptions in our baseline scenario in what the current trajectory represents?
Sure. So it basically when we do our reference case policies, we tend to do it sort of, and it's sort of with the equivalent of Environment and Climate Change Canada with measures. It's sort of like what policies really exist or are close to, they're in Gazette 1 or something like that, and so they're just waiting on Gazette 2. The design is slightly different, maybe in the Gazette 2, but fundamentally we know what the policy stringency is. So in the baseline, and we could put up the ERP. Someone could track down our ERP link and drop it in, and you can actually go through. We've got a very detailed policy document in there. So in the MOU scenario, or sorry, in the baseline scenario, we have tier in 2025 at $95 headline price, but unbinding, meaning prices were around $30 on average over that period as the traded price, and the headline price really only applied to sort of 10% of your compliance, give or take. So you've got a loose market in Alberta. And so instead of just saying, oh, there's a headline price and that's the carbon price everybody sees, no. We model it like, okay, the effective cost of these units, the average cost of these units, which also drive the marginal decision in the end. I won't get into the detail, but it's a bundle of compliance units. It has a price, and that's sitting well below the headline price. So Saskatchewan, zero price. The rest of the provinces, British Columbia's new OBPS system we have in the model with a fairly okay idea of their stringency rates, although LNG is a bit of an open question still. We have Ontario's program in there, Nova Scotia's Quebec Cap and Trade program as designed. So Ross and I did a bunch of work for the federal government on their benchmark review a few years ago. We've now done 2 of these independent assessments of carbon pricing systems in the country. And so we took a really deep dive into the regulations and the benchmarks, and we parameterized the Navius model to reflect and they do a ton of work in this space to reflect the regulations at play. So Alberta's weak system, no system Ontario in Saskatchewan, all the other programs as understood. CER, Gazette 1 regulation in there, methane regulation, 2030, 2035 is when it gets implemented in there, sort of as was discussed in the past. We have some LNG coming on. We have oil and gas growing at CER, Canadian Energy Regulator type levels in the model. And so we have, a view of what is going on in the country on energy and on economic development. And sort of that's the baseline. And then we just change levers for the MOU as we talked about.
Perfect. Thanks, Dave. And if people want more information about the assumptions in writing, much of that is also in the written insight in English et en français that's been shared in the chat. Bunch of questions about the price floor. One person asking, how is it built into the regulation? Is it written into the tier regulation? How would that be enforced, and why might the enforcement not work?
They've committed in the implementation agreement to put something in the window by the end of this year. So stay tuned. So we're going off sort of the language in the MOU. So the stratified vintaging, you got to basically submit a compliance unit in the year it was issued. There's often in the price floor a difference between the issuance year and the use year, and that typically those just follow the market. The use year just follows the market. That unit has the value that follows the market. In this case, you've got stratified units can only be sold if they're issued at $60 in 2030, they're worth $60. You got to top up if you use it later on. Seems to be the situation, which means they're falling in value in time as opposed to rising in value in time. So it's got this perverse banking effect. Normally, you would bank if you think, okay, prices are rising. One of the reasons we have the big bank in Alberta right now, there's relaxation around 2019 in some of the benchmarks, especially around oil sands. So we saw a big plume in units, credits into the banks. But also, it was sort of the Trudeau era and prices were rising. And there's a lot of people seeing, basically doing cash flow analysis. Okay, let's hang on to this thing. Expectations are it's rising. The floor flips that math around. And so that's one of the big sort of things that needs to be worked out and frankly figured out. Yeah.
Perfect. Quite a few people asking what the implications are for the rest of the country of the MOU, but also of the price floor specifically. Do we think the price floor will be embedded in the federal benchmark, the minimum
Yeah.
standards? What are the implications for Saskatchewan, where the price is zero? What do you think the implications are, Dave?
So the MOU process opened up a two-track political negotiation process and a benchmark, officials-driven benchmark review process. And in the past, the benchmark review was sort of approved by and directed by the political process, but it was very regulatory and okay, we understand it, here's where it's going, and there's consultation. This sort of broke that off. And so the question now is, oh, Saskatchewan and Ontario, like, where's our deal? Like so Alberta's, floor or ceiling is the new starting point, is it? The tightening rates? Oh, those are really weak. I'm going to do that. What happens if they adopt those tightening rates and not a floor? So if a floor doesn't get into the benchmark, which is the minimum national standard that all the systems have to meet, so you can think of the headline price as the minimum national standard right now. That's technically called the OBPS stringency criterion, which is kind of a mind bender. But so we have a ceiling price that is the objective of the program, but units are actually trading well below that. And so the question then is, does the floor become that sort of a band of regulated stringency that every province has to implement? And I think that is an open question because of the politics of it. ECCC may say, well, can we actually put a floor into can we have a price corridor, stringency at the top and the bottom? So there's some open questions there about what happens elsewhere. The CER takes probably pressure off in Ontario in particular around gas and gas prices and squeezing marginal costs. Ontario's electricity system is quite expensive, and gas on the margin with carbon pricing is a serious adder, especially for industry. And so the CER probably likely helps there. Methane, I think, unchanged. I think everything, yeah, I think that's enough. Ross, do you have any thoughts there?
No, I think I'm not conscious how many questions there are. I think you've covered all the
Okay.
all the essentials. So let's just keep moving.
Okay.
Since you were mentioning considerations for other policies, at least one person has asked about a policy we haven't discussed much, which is the oil and gas emissions cap that was proposed.
Yeah.
Do we have any insight into how this trajectory and the changes to other policies compare to what the cap might have accomplished?
Yeah, so the cap was a binding constraint. It wasn't a significant binding constraint in the short term. It was sort of, I think, cumulative 3 megatons over the pre-2023 period. So despite, I think, industries, I mean, there's two sides to this, right? If you're climate concerned, you're like, we needed the emissions cap. And if your industry, like you're going to wreck our bottom lines, it's a disaster. And so I think the real answer landed somewhere in the middle. Um, I will say that a well-designed carbon pricing system, when we tumbled the numbers, could have more cost effectively achieved what the emissions cap was trying to do, which was drive more reductions in other sectors that would then sell units into more expensive abatement sector, the oil sands sector. And so we were more or less agnostic between the two instruments, but we really, yeah, yeah. So it's hard to say, but I think fundamentally, the oil sands, or excuse me, the emissions cap was off the table pretty early, like really early, like immediately was off the table, right? And so in the first announcement, and so this government moved away, both governments moved away from it pretty fast.
Perfect. I'm going to come back to some questions on the price floor. One person's asked a pretty straightforward question. Would you rather have a price floor as it is, this price floor, or would you rather have no price floor? And maybe related to riff on that, what would you do to make this price floor more effective?
I mean, the stringency rates. So there's this academic view, and it's true. If you're the buyer of last resort as a government, you'll buy all the units. You actually don't care about stringency because you'll just pull all the units out, but it places a liability on the government's balance sheet. And so the idea would be that no government could afford to basically give out all this paper, have a weak price, and then buy it all back at a floor. And so that's the pure input. When you do that, you basically get the price rising. And so the challenge, but we're not there. We're not in a procurement situation. We're in a regulated situation where you got to prove each of these units, is at the floor. So there's leakage issues and the MRV I talked about. And so fundamentally, what I would say is that academic view, it's not the real world, sort of. No government's going to commit to that. So therefore, we need stringency that drives the equilibrium price above the floor. So that's the fix. It's not so this floor is a problem and it needs to be fixed, but it's compounded. The wonkiness of the floor is the risk of that floor not binding is compounded by the low stringency rates. So to give you an idea, I didn't mention this, and it's in the insight. These stringency rates knock 30% based on the stuff, roughly 30% of compliance out of 2030. So that's taken about 21 megatons, taking that down to about 14, 15 megatons of compliance. That's the difference. So weak market. When you looked at the 4% compounded out flat for the oil sands sector, and that drags up, as I said, about 3.5% tightening rate, that creates a lot of demand. It's expensive on the balance sheets, but that, something higher than where we are, or sorry, let me back up. So that the change in that stringency rate knocks nearly 65% of compliance off in 2040, 60-ish% off of compliance. So that the result of that is just a low price. So the problem with the floor, there's a problem there. The bigger problem is the floor becomes that load bearing piece because the market stringency is so low. And so balancing out tightening rates that hit the bottom line and that floor is really the challenge. And I'm just going to say the last point, that our timber to barrel analysis, 16 cents a barrel in 2030 is what the current price floor, if it binds at $60, and these tightening rates works out to be 16 cents net per barrel. So yes, it's billions of dollars out to 2040 with the high tightening rates, but at the flip side is it's really low right now.
Perfect. Thanks, Dave. A couple people asking about implications for other credits or other projects. For example, let me scroll to find this. Do we have any perspectives on how the MOU could affect renewable credit generation in Alberta?
So for me, the big win, one of the big wins in the MOU was unsticking renewables in the province. So renewables are crediting under tier, and that's been a major driver of activity, project development in the province. Maybe there's some project developers online, some tier people. You understand this. The provincial government shut it down, and it's slowed to a crawl. So unsticking that is good on a number of levels. It creates financeable projects, and I think more importantly, the CER and the Canadian, or excuse me, the Alberta electricity system, being with an increasing dependence on natural gas in your competitive market in Alberta, you only are subjecting yourself to major price volatility and high prices, right? The pool price tracks generation on the margin, which is gas. And so what we find in the modeling we've done on the CER, that to the extent you can bring batteries in, and you just have to look online and social media about how batteries are shaving off shoulders and peaks, adding to base load, renewables as well, interties, demand side management, anything that can reduce the amount of gas on the margin in the system reduces costs, and it helps with affordability and competitiveness. So the unsticking of renewables, I think, was a big deal in the system, and we'll see how it plays out. But from a modeling perspective, the electricity system it looks to be more stable to the extent you can build in pricing wise, build in these other sort of renewable pieces as a complement, right? It's not like get rid of all the gas. You can't because you need you need backup and you need peakers and all this sort of stuff, but you can reduce the price impact with this other stuff. Yeah.
Perfect. Thanks, Dave. Speaking of credit generation, a couple of people are asking about credit generation under the clean fuel regulations.
Ah,
People have noted that the agreement commits Canada to maintain a minimum credit creation rate of at least 20% for upstream carbon capture and
yeah,
storage projects.
yeah.
So could you comment on the significance of that part of the MOU?
It's significant, but it's not a game changer. So looking at it, it looks to double what you can get at a tier, and so it is adding revenue in, but it's capped because the problem with the CER market has a lot of problems. Prices are really, really high, supply is low, and it's a constrained market, but it's a functioning market, and so there's this concern about scarcity in that system in the short term. In the long term, when you get a bunch of CCS come in, because there's these different compliance pathways, and the CCS compliance pathway, to the extent it's used, it reduces the biofuels pathway, and there's additionality concerns and this sort of thing. So what they did is they've limited the use of the CCUS pathway in it, which is the abatement investment pathway, basically CC1 it's called. And then so that 20% is basically capping the impact in the CER market on biofuels, basically. And so what it does, stacking, you can stack those CERs now with your credits, with your tier credits. And I looked at the numbers. It's been about a month or 3 weeks since I looked at it, but it looks to like not quite double the value of the two credits together. So it is fairly significant, but there's not a lot of it there. So if you can get it, it's really useful, but it's not really widespread. Like when you do the math, it's not a game changer, but it's a helper. Like, does it make CCUS viable? No. Does it help with financing? Well, it reduces the government subsidies required and the market price required to close that financing gap on pathways.
Perfect. You were addressing this a little bit by speaking about pathways, but people were wondering how we accounted for the Pathways project in the analysis. Did we take the project sort of at face value, or were there other considerations that we made?
Yeah, pathways. So the Navius model is optimistic on CCUS, as all the energy models are. So we get about 25 megatons, 26 megatons of CCUS in 2035. In the baseline, I think we get 10 or so megatons in 2030, which is optimistic. So I would argue we're optimistic in there for CCUS, but not crazy and aligned with other thinking. And so, like, if we are more cranky about CCUS and less accepting of its technical potential or its economic potential, the mission outcomes could be worse. So basically, our runs are contingent on 26 megatons in 2035 of CCUS, not just in oil sands. There's a bunch of CCUS all over the place. There's EOR, enhanced oil recovery ITCs in the implementation agreement that were announced in the MOU initially. So that drives some CCS, but the EOR economics aren't great either. So again, it's a modeling artifact. So anyway, we're a little positive, a little euphoric, and we could be a little too euphoric, but that's how modeling works, right? I mean, we could look at a whole series of assumptions that are puts and takes, but the CCUS one is important.
Perfect. Back to electricity again. This is a broader question than the MOU. Someone's wondering whether the new electrification strategy could lead to higher electricity emissions in Alberta or elsewhere. They're also wondering about natural gas for data centers.
Yeah, to be determined. So maybe I'll deal with that last one first. So data center demand, any increased demand in Alberta. So the dynamic I talked about earlier about gas on the margin, scarcity pricing under the CER, or anything that constrains supply, a new generation supply in Alberta, or generally anything that constrains new supply, drives those prices up, and really reinforces that affordability dynamic, anti-affordability dynamic, where prices rise really, really fast. And so the electricity strategy, is really euphoric on nuclear, really euphoric on gas, and kind of waves its hands at renewables. And so we were happy to see in the MOU the renewables in there, again, from a pure affordability perspective, and then you get the emission benefits. So yeah, I mean, the Institute, we're working on, I mean, electrification's hot right now, but we've been working on stuff for quite a while. And we've got a new report coming out at the end of the month. I don't know if I'm allowed to say the name because it was the big unveil, but we're working a lot on electricity and electrification. And so stay tuned. And the electricity strategy still needs, some framing up. Like, what is the CER going to actually happen in there? They sort of wave their hands at offsets and changing the end of life. And so stay tuned. But generally, its reliance on natural gas and nuclear, it's overweighted I would say it's overweighted in those two areas, and not as balanced as it likely could be.
Perfect. Okay, we're going to come back to the MOU and carbon pricing. Let's start with a couple of questions on what's in the modeling. First, simple question, does the modeling account for offsets? And if so, how are they represented?
So the Navius model, we basically throw the Navius model doesn't have a great market equilibrium. We have a separate market model that we use, and in that model, where we're really have learned about how the floor is going to interact, and we can actually code in the stratified vintaging, code in the grandfathering, code in the price floor, figure out market dynamics, bring in. I mean, the Alberta offset system has been delivering about 5.5 to 6 megatons a year since 2011, 2012, unchanged, unaffected by price. So to the extent those offsets, and the offsets like are important for compliance, right? They're heavily used, 40% over time. And so they are appreciated in the system by, I think, compliance entities and developers alike. So we have offsets in there. In the Navius modeling, we basically throw the bank in that reduces compliance demand. So firms grab on the bank. So it's a really simple representation. And that way you think about it, we just have basically lower compliance demand, and then the system doesn't bind, meaning you don't hit you don't hit the ceiling price or the floor price or whatever trajectory you're trying to hit. We allow the market to settle out based on the tightening rates and subject to the overhang in units. And then our market model does a much better job at that. And basically what we find is that the bank generally clears out with expiry between now and 2030, and into 2032, 2033, there's some hangover, which then reduces the effectiveness of the floor. So yeah, we've looked at the bank. Yeah, and it matters.
Another question on what's in the modeling. Someone's wondering about economic impacts. Did our modeling look at economic impacts of the various scenarios?
Yes, we look at GDP. So if you want to see what the economic impacts look like, we have another insight where we focused on that. This one was just on emissions, but we have another, and yes, we looked at, I mean, the Navius model does, we got market prices in there, we got tier prices, we got all kinds of economic impacts, government balances, it's all in there. So if you look at our previous insight at 440 on weak versus strong MOU, basically the difference between a weak and a strong MOU was very large in emission reductions, hardly anything in GDP, hardly any change in GDP at all. So I think of the oil sector as an ATM machine, right? It just, once it's there, and the pipelines are ATM machines, right? Once you unstick the market access challenge and you close the differential between the WTI and the Western Canadian Select, as TMX did, and as Line 6 did, the Enbridge pipeline in, I think, 2019 or I forget, 2021, the differential falls and profits go through the roof. And so we see this, right? And so in the model, we saw basically, in that modeling, we saw basically a $2 to $3 differential would pay for all the climate work, a closing of the differential. So we see basically a large emission difference between a weak and a strong MOU and a very small GDP difference because that oil pipeline is just driving a bunch of, value in the system. And with and without the pipeline, I mean, you would see it in the numbers. It wouldn't be massive. I mean, these are, Canada's a $2 trillion economy, and a pipeline matters for bottom lines and government balances, but sometimes it's a little noise in the macro economy, right? So it's you have to drill down to really sort of see its impact. But certainly for those who are now getting 10 or 12 bucks more a barrel, because that diff reduction, I mean, that's straight to the bottom line, and certainly government balances in Alberta and the federal government are better off.
More questions about the sort of future of carbon pricing. Someone's wondering about the idea of making credits fungible, trading across different carbon pricing systems.
Yeah.
Do we think that's on the table? What do we think of that idea of making, do we think there are discussions about making credits fungible across different
Yeah.
systems?
I keep pulling out decks from 2008 and blowing them off, saying, hey, fungibility, lower cost. So I think there's an opportunity with this prime minister to link markets, the One Canada objective that he brought in, and he's talked quite a lot about linked markets. Um, I think the people around him and the officials have basically said, "Well, hang on, because these systems are just some are watered. Like Tier has all these extra units, so how's the trade going to go? What's the flow going to happen?" And basically, the BC market doesn't have a lot of compliance demand because they have a large requirement to pay into the tech fund, and it leaves a little room for the market. So you actually have a really depressed price there. So actually, you'd think, oh, excess units. Let's link BC and Alberta. Oh, Alberta has excess units. Compliance costs are high in BC. Let's flip them over there. And then the market is over, the market's really thin in Alberta because this big 60%, fund payment requirement versus 10 in Alberta, there's no trade. Trade in Ontario is a different story. Ontario will take all the units you can get. So the economics are there. It's just the MOU at this price floor kind of made it a little wonky. So we still have to sit back and think about it. Could we move that way? Absolutely. And then the last thought, offsets. Fungibility around offsets and getting our protocols aligned is probably a simple way to get going. Adopting standards on the protocols, not everybody having their own, I mean, longer term issue, and then allowing for some offset trade like Alberta and the federal government have right now. So, yeah. So, linking, stay tuned, get back to us in 12 years, and we'll all have a talk about this.
What about coverage? Carbon pricing systems
Yeah,
currently have different coverage thresholds. Do we expect that to change? Do we expect tier to change? Tier's threshold is much
great
higher than
question.
other systems.
Yeah, so the benchmark review asked questions about tier, or excuse me, about coverage. It's a mishmash in our carbon pricing review. The report that Ross was the lead author on, we looked at this stuff, and it's a mishmash. 10,000 tons, 15,000 tons, 100,000 tons, or not 15, 20, I guess 25, 10, 25. Is there a 15, Ross? I always forget.
There is, I think, a 15. I can't remember Newfoundland off
Yeah,
the top of my head, but
yeah.
yes, I think
So
there might
so
be
it's all
15.
over. So you have this So when you had the car, yeah, mis misalignment, we have an interjurisdictional competitiveness challenge where some facilities are in industrial carbon pricing in one jurisdiction and they compete against another Canadian facility in another jurisdiction that's out. So you'd argue that we have this leakage competitiveness problem domestically. And occasionally we see it in the modeling where it's like some facilities, there's a lot of leakage that go into those sectors when they don't have it. So anyway, all that to say, the MOU left it unanswered. The order in council that was put out in late December by Alberta indicated a 50,000 ton threshold, and we thought maybe something would show up in the implementation agreement. So I think look to the benchmark review to see where they end up. So it was clearly unsettled. It was an unsettled point. So I think the benchmark review will have to pick that up. So uncertain.
Right. We've gotten through a lot of questions, but they are still coming in. So I don't think we're going to get to all of them. I'm going to start merging some questions and we'll try to fit in maybe, a couple more, but we'll wind down soon. I'm going to merge a couple questions here. One person's asking about what works better. These are fixes to systems. What about having carbon contracts for difference versus a carbon bank or a credit bank run by the governments? Would either of those have an effect? And another person has said, are there examples of fixes in other countries that we could be thinking about?
Yeah, we can go on all day about this. So contracts for differences, the way they're designed here, sort of bespoke. Well, we don't know if they're going to be bespoke. They could be a term sheet, but they're limited in size, so they're going to have no impact on market scarcity at all. They're purely going to be providing, some sort of insurance, finance insurance for projects. And so they do nothing for the market fundamentals. So they help with project finance. But the challenge, though, as I see it, is that it looks like the liability is capped at $16. Alberta's making noises to that effect, as opposed to having a larger liability. So if some of your units you can't sell, let's say you can't sell your unit, there's a market price at the floor, but there's a surplus of units. You can't sell your units, and you're sitting $20 below the floor price with the sort of secondary marketer that your stuff's not moving. Is the $16 enough to close the gap? And I think if the floor fully worked, it would sort of be like an incentive booster, but there's a fundamental mismatch here. And so CCFDs in a broader procurement setting where it was like a term sheet, we're going to give it to everybody and that'll drive a floor price possible. I don't think there's any examples of that out there. So CCFDs are good, but I think in this context, they've been marginalized a little bit. And so we'll see. And then in terms of what works globally, typically to get a price floor, you have an auction. So firms have to, and you can have consignment auctions where firms have to bid on from the government with a minimum floor price, like in the WCI, for a share of their allocations or a share of their benchmark. And then the consignment is the government could give that money back so it doesn't hit the balance sheet. So you get price discovery, you get auction, there'd be a floor price at auction that would then set expectations like in the WCI across the board, one unit, one price and time. And so that's typically what goes on to implement the price floor. It's through auction. And they chose not to do that here. And they got out their pencils and drew something that I don't really understand entirely.
All right, we're pretty much at time. I'm going to throw you one last question, Dave. Some big picture implications, if you can do it quickly. People are wondering, where do we think the MOU fits into the larger trajectory of Canada's emissions? Is this lost opportunity, as you said? Is it a step backward? And what hope do we have or opportunities are there to get our trajectory back on track? Nice, easy question
Nice,
to
easy
close things
question.
off.
Well, all the emotions, all of it. So you sort of look at the MOU and say, oh, it's locked. Carbon pricing's broken. We have every 3 or 4 years, we redo carbon pricing in this country. And so stay tuned. I think the view on this thing is to not think it's locked down and everything's been negotiated. I actually think it's the reverse, that I think there's going to be some sharp pencils that need to come out on decisions that were sort of like made on the 2 yard line just before they brought it home. And so stay tuned. I think there's a lot, the structure of our emissions is roughly 40 to 44%, depending of our emissions sit in large emitter programs coast to coast. And if you take out the land use emissions, it's a much bigger share. So this is not going away. This problem is not going away. What are the other policy solutions? The only thing that's ever stuck and continues to stick is industrial carbon pricing and subsidy programs. The regulatory stuff is, maybe we could do some stuff around heat standards, but I mean, it's a reg, so good luck. So anyway, stay tuned. I think we can't give up on it, right? There's this sort of notion in the brain that, oh, we're done with this. I think basically, if you're interested, there's room to influence this thing continuing forward. And that's really the issue. And frankly, with the way oil sands emissions are, such a 20, oil and gas 25 plus of our, 30 something, 33, I think, oil and gas, third of our national emissions. We got to continue to do something there if we care about reducing emissions. So this problem isn't going away, and we'll have a webinar in 15 years, and maybe I'll listen to one of you folks of the latest outcomes, because we're still going to be at it. So that's it. So thank you, folks. Send us a note, good or bad. Send us your questions. Check out our work. support us. And thank you for attending. And yeah, looking forward to seeing you in the halls of various places. Come say hi. Thank you.